Welcome, everyone. Today, we're going to tackle a topic that I promise you is absolutely fundamental to your future careers. Doesn't matter if you're going into finance, marketing, or even operations. We're talking about accounts receivable. And we're going to move way beyond the simple definitions you might find in a textbook. See, AR isn't just some line item on a balance sheet. It's a story. It's a story about a company's relationship with its customers, how efficient it is, and frankly, its ability to survive. Understanding this story is what separates a good manager from a great one. So let's get started.
Okay, let's just jump right in with a scenario. I want you to imagine you're running a small, growing company. You've spent weeks pitching, negotiating, and you finally land the big one, a $50,000 contract with a brand new client. This is a huge win. Now, according to the rules of accrual accounting, which is really the foundation of all modern financial reporting, the second you deliver that service or ship that product, you get to officially recognize that 50 grand is revenue. Bam, it goes right on your income statement. And for a minute, you feel amazing.
And then reality sinks in. The invoice goes out and the payment terms are net 60. What does that mean? It means you're not going to see a dime of that cash for 2 whole months. So while you've earned the $50,000 in an accounting sense, it's not actually usable. You can't use it to make payroll next week. You can't use it to cover this month's rent or pay your own suppliers. And this gap, this space between recognizing revenue and actually receiving the cash, well, that creates a huge challenge for managing a company's money. Learning how to navigate this challenge is exactly what we're here to master today.
So to really get our heads around this, we're going to follow a clear roadmap. First, we'll look at what we're calling the promise of payment and how that gets formalized. Then we'll get into the official language by decoding accounts receivable. Next, and this is crucial, we'll explore why it's both an asset with risk. From there, we'll get practical with the manager's AR playbook. And finally, we'll wrap up by learning how to view AR as your financial X-ray, a tool for diagnosing a company's health.
All right, let's start with Section 1, the promise of payment. What we're doing here is tracing the journey of a deal, from a simple handshake or a signed contract, all the way to how it gets officially recognized as a real, tangible asset on a company's balance sheet. This is the first, most fundamental step.
So that $50,000 your client owes you, it's not just some casual IOU. In the world of accounting, it is a legally enforceable claim that represents a future economic benefit to your company. This is so important because of a rule we have called the matching principle, where we try to match revenues with the expenses that helped generate them in the same period. Accounting standards require us to recognize this sale as an asset the moment we make it. It's not just an option, it's the rule. And that's what transforms an informal promise into a formal asset on the books. Okay, so now that we understand the why, let's get really precise with the what. This brings us to our second section, decoding accounts receivable. As future managers, future executives, you have to master this vocabulary. It's non-negotiable. We're about to learn the official language for money owed to a business. So let's get the formal definition down. Accounts receivable, you'll see it abbreviated as A/R, is simply the money owed to a business for goods or services that have been delivered or used but not yet paid for. Now, on the balance sheet, it's always classified as a current asset. And the word current in accounting has a very specific meaning. It means it's an asset we expect to convert into cash within one business cycle, which is usually a year. This classification is vital because it directly affects how we analyze a company's short-term financial health, or what we call its liquidity. Now, it's really important to know that not all receivables are the same. The vast, vast majority of what you'll run into are trade receivables. Our $50,000 sale? That's a perfect example. It comes from the normal day-to-day business of the company. But sometimes for bigger amounts or maybe higher risk customers or longer payment terms, a business might require a notes receivable. And this isn't just an invoice. It's a formal, written, legal document, a promissory note. And notice the key differences here. A note almost always has an interest rate attached to it to compensate the business for waiting for its money. And it has a specific legally binding due date. All right, now we get to the real heart of the matter for decision makers. Yes, AR is an asset, but it's an asset that comes with a whole lot of risk. And a big, impressive-looking number on the balance sheet isn't always the good news it seems to be.
Let's say you're analyzing a company's financials and you see this, $1.2 million in accounts receivable. Your first thought might be, wow, they are crushing it. They must have a ton of sales. It looks great. It suggests a really successful, thriving business.
But as a sharp analyst, you have to immediately ask the next question. What is the quality of that $1.2 million? How collectible is it really? What if a huge chunk of that money is from customers who are 90, 120, even 180 days past due?
What if some of those customers are struggling financially, or worse, have gone out of business? All of a sudden, that impressive asset on the balance sheet starts to look like a huge problem just waiting to happen. This brings us to the two faces of AR. On one side of the coin, it's an asset. It's a claim to future cash. But on the other side, it's a risk. The risk of what we formally call bad debt, which is just money you're never going to collect. So this one number is actually telling you multiple things. It tells you about the company's liquidity, its ability to pay its own bills, and it's a direct reflection of the company's policies. Is management being too loose with credit just to pump up sales numbers, or are they being smart and disciplined? The answers are hiding in the AR details. So that brings us to the manager's job. How do you go from just reading these numbers to actively managing them? How do you make strategic decisions? This right here is the core of accounting for decision-making.
The single most important tool in any manager's playbook for this is the Accounts Receivable Aging Report. Don't let its simple look fool you. This thing is incredibly powerful. It just lists every customer's balance, and here's the key. It breaks that balance down into columns based on how old the invoice is. Current is great, but as you move to the right into those 30, 60, 90-day columns, the chance of ever collecting that money drops, and it drops fast. This report turns one big useless number into an actual actionable risk map.
So if you're the manager looking at this report, your eyes should go straight to the problems. ABC Corp, perfect, they're current. Innovate Inc., okay, they're in that 31 to 60-day bucket. We need to send our reminder, but it's not a full-blown crisis yet. But Global Tech, $15,000, that is more than 2 months late. That is a massive red flag. The likelihood of collecting that money just fell off a cliff. We have to do something, and we have to do it now. So, what do you do about Global Tech? You follow a process. Step 1, analyze. We just did that. We identified the 15 grand as high risk. Step 2, assess. This is where you play detective. Why did this happen? Did our sales team give them credit when they shouldn't have? Is our collections process broken? Is Global Tech having bigger problems? Step 3, act. This is about execution. We start a pre-planned collection process. Maybe it starts with a friendly call from their salesperson. Then it escalates to a formal demand letter from finance. It could even mean cutting them off from future credit. And step 4, strategize. This is the most important part. We use this incident to get smarter. Do we need to change our credit terms for Global Tech specifically? Or did this just show us a major flaw in our overall policy that we need to fix for everyone? Now, I want to quickly point out a few common mistakes I see students make all the time when they're analyzing AR so you can avoid them. The first is just looking at the total balance, which, as we've said, hides all the important stuff. The second is pushing for a credit policy that's too loose. It's so tempting to offer easy credit to make more sales, but you can literally sell your company straight into bankruptcy if nobody pays. Third, not following up quickly. When it comes to collections, time is your worst enemy. And finally, not looking for patterns. Is Global Tech always late? Because if they are, your decision about giving them credit in the future should be very different than if this was just a one-time slip-up. Okay, this brings us to our final section, and it might be the most important one. I want to leave you with a really powerful way to think about all of this. I want you to think of accounts receivable not as a line item, but as a financial X-ray. If you know how to read it, it gives you an unbelievably clear picture of the inner health of a company. And let me be really clear about this. Understanding AR is not just for the accountants in the room. If you're going into sales, AR tells you which of your customers are actually profitable and which ones are just a drain. If you're in marketing, it tells you about the quality of the customers you're attracting. If you're in operations, it directly affects how much cash you have for inventory. It is truly a vital sign for the entire business, connecting every single department. I want to leave you with a classic business quote that just perfectly sums up everything we've talked about. Revenue is vanity, profit is sanity, but cash is reality. That big, impressive sales number you book, that's the vanity. The profit margin you calculate, that's sanity. But the actual hard cash in the bank, that is the ultimate reality that decides if your business lives or dies. And accounts receivable, it's the fragile, sometimes dangerous bridge that connects the vanity of a sale to the reality of cash. Your job as a future business leader isn't just to build that bridge by making sales. It's to manage it, to reinforce it, and to make absolutely sure that every single dollar makes it safely to the other side.